wind down a bit as the market digests the jobs report and new tariffs. Yesterday, the SEC laying out what it's calling Project Crypto, a plan to modernize regulations and allow for crypto-based trading. And joining us now here first on CNBC to discuss it is SEC Chair Paul Atkins. Chair Atkins, welcome. It's good to have you.
Thank you, Sarah. It's great to be here.
So I read your speech. I mean, my takeaway is this is not the SEC under Gary Gensler. This is a new regime. What do you want people to take away from Project Crypto and what you're saying about it?
Well, thanks for that question. So it is a new day at the SEC, and we are picking up the gauntlet and the challenge that President Trump has laid down to make America, the crypto capital of the world, and to have U.S. technology basically running the world running on U.S. technology. So there are a lot of ways that we can help do that, and that is provide certainty and regulatory certainty and good rules that are fit for purpose for the crypto industry, so that innovators know how to innovate and investors know what they're investing in, and that everybody can have certainty so that it's on a firm foundation.
I mean, one of the biggest questions on that front, Chair Atkins, is whether you classify crypto as securities, and you said most of them are not, and I just wonder how you're thinking about that and reconciling that with the Howey test, which is how you determine what are securities.
Well, the Howey test applies to a term called investment contract that was in the securities laws back in the 30s, and the Supreme Court construed that in the case of orange groves and oranges, and investors in that, whether or not they had a security or not. And so that's the law of the land as far as investment contract definition goes. But and that there have been, over the last 80 years, a number of applications of that. But it's, in the 21st century now, we have, at the SEC, we have authority that we can use to help construe that and develop that farther into the 21st century. So we aim to do that. So not every crypto asset is investment contract or therefore security. And we're out to give people certainty in that with good rules that give them the guardrails to innovate and to be able to take things to market.
But if most of them aren't securities, then what? They get regulated from the CFTC. I mean, there are a number of regulators here, including treasuries. How do you make sure that there's not some sort of overlap when it comes to how you're classifying crypto and regulating it?
Well, so that's what's the beauty in the PWG report. So we've been collaborating with our fellow regulators and the bank regulators and the CFTC and Treasury to develop this report, the DOJ as well, and Commerce. So so what we have to do is have a system that it provides certainty, but by that that could have overlapping jurisdiction. But we have to have flexibility for market participants and people who are innovating, so that they know that they're not going to get caught in a trap, which is too often what they've had to do here in the past several years. So we will work with Congress. They just passed and enacted the Genius Act here a couple weeks ago, and now they're working on what's called the Clarity Act that the House has passed. I commend them for doing that, and now it's in the Senate, and the senators will be addressing those issues, and there'll be a back and forth, but we're working with them and look forward to having a system that makes sense for this budding technology.
Right, and it sort of goes along with I think you've used the words predictable compliance pathways. But I'm curious what exactly, or if you can give us some sense as to what that really will mean for the likes of crypto exchanges or the protocols that underlie decentralized finance.
Well, the one thing about these predictable pathways, in the previous question about overlap, it's fine to have overlap, and if you look at the bank regulatory system, there's overlapping jurisdiction between various regulators, but there's certainty as to what the market participants can do in that area. So if we have flexibility, a flexible type of framework, I think that's the best. No turf battles, because the battlefield is strewn with corpses of old potential products like single stock futures and others that got caught up in a regulatory turf battle in the past. So we have to put that aside. We have to keep in mind innovation and investing and make sure that people have certainty and they won't get caught up in it.
I mean, how do you ultimately make sure that the crypto industry is not set up for another crisis like FTX? I mean, the crypto contagion. I think that was the worry about the last on behalf of the last S.E.C. and just generally taking a lot of these recommendations from the industry themselves when it comes to regulation.
Well, investor protection is, foremost in our mind, as well as capital formation and innovation in the capital markets and so forth. So there's a balance there. But FTX is a good example of had it been a part of, rather than being offshore, had it been onshore in America under American regulation, I think there would have been a totally different development of that and outcome. They could not have done what they did. They owned a subsidiary here in the U.S. that was the old Ledger X that was under CFTC regulation. No investors lost any money. There was segregation of assets and not the hanky-panky that went on in Bahamas and offshore.
Yeah, a good way to put it. Well, we look forward to hearing more as you lay out this structure for regulation. Thank you for joining us.
Thank you
here
for
on
having me.
today's initial plan. Paul Atkins, the chair of the S.E.C.